we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past.
Once a year, we get blessed with the Daily Journal annual meeting, which is essentially a 2-hour Q&A session with one of the greatest investors of all time, Charlie Munger. And to be completely honest, I tend to find myself aligning with Charlie Munger's investing principles even more than Warren Buffett, who of course was ultimately influenced by Charlie Munger into turning his strategy into looking for great companies with long-term prospects. Charlie Munger is one of those people who just gets straight to the point. He doesn't fluff around to add color to his answers. He just answers the question straight to the point, and he lets a small number of simple principles guide him, which is why it's so easy to listen to him and follow what he has done in building his wealth and career over time. Today's video is going to be pretty simple. I'm just going to go through and break down some of my favorite and most interesting clips from the Daily Journal annual meeting, where not only does he talk about some of his investment positions and rationalizing them, but also about what are some of the biggest risks and challenges that we as investors are facing in 2022 and beyond. And of course, within that, he talks about what he thinks is the biggest threat to investors today. Also, quick shout out to CNBC for completely fabricating not one, but 2 quotes from Munger in this meeting. When I'm thinking of a title for my YouTube video, I often look for inspiration in journalism and news articles because they often have really catchy, exciting titles. And this one CNBC article caught my eye because it said something that I was pretty sure Munger hadn't said during the meeting. So I used software to transcribe the entire meeting, and the 2 quotes that CNBC that you see here they include in their article never were actually said by Munger. If you enjoyed this video, make sure you hit subscribe so you stay up to date when I post new content like this in the future. And if you haven't already, make sure you go ahead and download SHARESIGHT via the link down in the description below and start tracking all of your trades in one place and accurately.
Ami Patel from California, you recently talked about bubbles and high valuations in your Sohn conference talk. Is Costco a part of that? Costco has never traded at a higher price to sales or price to earnings multiple. How should new investors think about Costco given its record run?
Well, that's a very good question, and I've always believed that nothing was worth an infinite price. So at even an admirable place like Costco could get to a price where you would say that's too high. But I would argue that if I were investing money for some sovereign wealth fund or some pension fund, and a 30, 40, 50-year time horizon, I would buy Costco at the current price. I think it's that strong an enterprise and that admirable a place. Now, I'm not saying I can't bring myself with my habits to pay these big prices, but I never even think about selling a share of Costco just because it's selling at a high price.
Here, Munger reiterates one of the most fundamental principles of investing, which is that an asset is not worth an infinite price, right? You have to make an assessment between what you're paying and what you get out of it. But even given that, and given that Costco is trading at its highest point and has consistently continued to get more expensive relative to its current earnings, he still believes it's not at a price where it's not worth an investment. But the big caveat to that is, he says, if you have an extremely long 40, 50-year time horizon. So if you're going to hold the company for that many years, for many decades, then it's not over expensive, but maybe over a shorter period it might be. And you might wonder, how does that make any sense? How does the time horizon for the company, or how long you hold the investment, how does that affect whether it's expensive or not expensive? Well, what he means by that is the price for the stock right now is extremely high compared to its current profits. So if you're just looking at the yield on cash flow, or the cash flow yield that you're getting out of this business, if you buy it today and the business produces the profit it's producing right now, then that's a pretty bad relationship. However, he believes that Costco is in a powerful competitive position so that it will thrive over many, many decades and remain one of the strongest general merchandisers for an extremely long period of time, consistently being able to raise their prices and expand internationally. So over the very, very long term, the ability of that business to produce cash flow should be consistent and also increasing over time. It's kind of a similar argument to investing in index funds, in that, let's say we knew that we were right at the top before a big crash was going to come. if you had a 5-year horizon, if you needed that money back in 5 years, it's probably not a good idea to have that money in the market. It's probably a good idea to put it somewhere where it's not going to move as much and not be as volatile. But if you're investing for the next 30, 40 years, it doesn't matter that it's the top of the market. It really doesn't matter what kind of market it is. Over the very long term, that group of businesses, let's say the S&P 500, will consistently become more productive, and it grows over time. So even if you had invested at the worst points, at the peaks of each of the crashes, you still did very, very well over time. And he's making a similar argument to that for Costco.
China is uninvestable, in my opinion, at this point. I've never invested in China long or short. Why is that? I don't trust the data. I don't trust the relationship between the United States and China anymore. I think that investments in China could be confiscated. I think there's a risk of that, end quote. Obviously, with a significant percentage of the Daily Journal's marketable securities invested in BYD and Alibaba, you feel differently. Please explain why you are right.
Well, of course, only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. And we invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. Other people, including Sequoia, the leading venture capital firm in the United States, have made the same decision we have. But I'm sympathetic to Gunlock. If he's nervous, he doesn't have to join us. Different folks have different opinions. I feel about Russia the way he feels about China. I don't invest in Russia, so I can't criticize Gunlock's point of view. It's just I reached a different conclusion.
Munger spoke a lot about his Chinese investments. He now has a couple of major investments from the Daily Journal that are in Chinese companies. And the simple reason why he likes Chinese companies over other kinds of companies at the moment is because they're simply better value, right? Their prices are more attractive compared to the profits that those businesses are producing. And not only that, the competitive landscape for a few particular businesses is a lot more different than the US. In a lot of industries in the US, there's a lot of competition. Whereas if you look in China, something like Alibaba or Tencent, these are massive giants that don't really have a huge amount of competition immediately around them, meaning they have these deep competitive advantages and their stock prices are smaller or lower relative to their current earnings.
This one came in from Wasim. He said, although the financials seem strong, do the political pressures from the Chinese government worry you at all?
Think of how massively stupid both China and the United States have been to allow the existing tensions to arise. What bad is ever going to happen to China or the United States if we two are close? If we make good friends out of the Chinese and vice versa, who in the hell is ever going to bother us? Of course we should make friends with China. And of course we should learn to get along with people who have a different system of government. We like our government because we're used to it and it has advantages of personal freedom. China could never have handled its life with a government like ours. They wouldn't be in the position they're in. They had to prevent 500 million or 600 million people from being born in China. They just measured the women's menstrual periods when they came to work and aborted those who weren't allowed to have children. You can't do that in the United States, and it really needed doing in China.
Munger doesn't seem to think that a conflict between the US and China is a threat to his investments in China. And he tends to, well, not tends to, he just flat out doesn't really take any moral positions on what the Chinese government does on certain things. He simply just doesn't judge them, essentially, is what he says in the Daily Journal meeting. And honestly, with this section, I couldn't disagree more with Charlie Munger. I think that it's okay to judge different countries for operating in different economic systems. Of course, on a country-by-country basis, I think it's very, very difficult to reach an argument of which one is doing things better for their people because they'll have slightly different policies, different approaches to things. And it's hard to judge one country to another, like, you know, the US to Australia or the US to the UK. I think it's difficult to make those comparisons. But when you have a country that is operating under a system where people don't even get a voice in who makes the top level decisions for the country, I think it's okay to reserve or have some judgment on that system as one which isn't run by the people, which is ultimately what I think it should. I don't want to get too political in this video, but he made some comments throughout in various things in relation to China and other things as well, that kind of made it seem like he's very out of touch with a lot of issues. Just to give you an example, his comment on forced abortion in China, pretty much him saying that it was a good thing, is probably the most absurd thing I've ever heard him say. And I think he should just stick to talking about his investments and maybe not stray into the morality of forcing people to get abortions. Throughout the entire 2-hour meeting, Charlie Munger spoke on inflation a number of different times, and I'm gonna splice in a couple of different clips of a couple of different things that he spoke about. But I think it's very, very obvious that he thinks that inflation, and really more than inflation, how the Federal Reserve reacts to it, is going to be one of the most important things that influences stock market investing over the next few years.
When you throw money, when you print money on the scale that modern nations are printing it, Japan, the United States, Europe, etc., we're getting into new territory in terms of size. The Japanese bought back not only a lot of their own debt, but a lot of their common stocks. So the Federal Reserve System, you can't imagine how much money printing Japan has done. And they haven't had all that much inflation, and it's still a very admirable civilization.
In this first clip, he compares the US to Japan, where Japan has apparently been able to do a significant amount of money printing without terrible consequences. And I'll be honest, I don't know a whole lot about Japan's economy over time. The only kind of thing that I know about it is the fact that the stock market actually peaked in the late 80s and has still not recovered to that period. They went through a massive asset price bubble, and the result of that was absolutely devastating. I think the overall Japanese market was down about 80% at its worst point. So of course Japan is a functioning economy. They're doing, you know, absolutely fine. You would still rather have a market, of course, that didn't have asset price bubbles where the market still hasn't recovered, you know, 30 years later. We would much rather have a slow, steady increase in wealth, because most people have money invested in the stock market broadly, either through their retirement funds or individual stocks or whatever it is. We would rather not see these massive periods where it's really bubbly and people are willing to pay anything for stocks, and then periods where that retracts. Makes it a lot more difficult for people to have confidence in consistently investing.
There's never been anything quite like what we're doing now. And we do know from what's happened in other nations, if you try and print too much money, it eventually causes terrible trouble. And we are closer to terrible trouble than we've been in the past, but it may still be a long way off. I certainly hope so.
But then he kind of switches lanes, and he does go on to talk about how historically, when nations have done large amounts of money printing, there have been serious consequences one way or the other. Whether it is that the US in the late 70s, early 80s, where interest rates needed to be raised up to 20%, and that caused a long and deep recession, or inflation is let go and there's no kind of strict monetary policy that brings inflation back down, and you see massive hyperinflation and the devaluation of currency.
When Volcker, after the 70s, took the prime rate to 20% and the government was paying 15% on its government bonds, that was a horrible recession. Lasted a long time, caused a lot of agony. And I certainly hope we're not going there again. I think the conditions that allowed Volcker to do that without an interference from the politicians were very unusual. And I think in 2020 hindsight, it was a good thing that he did it. I would not predict that our modern politicians will be as willing to permit a new Volcker to get that tough with the economy and bring on that kind of a recession. So I think the new troubles are likely to be different from the old troubles.
I agree with Charlie Munger here that we really don't want to see a long and prolonged recession like the early 80s. But what we also learned from that period is that inflation was absolutely spiraling out of control. And if it wasn't for a massive increase in interest rates during that time, then it would have spiraled into hyperinflation, and that would have been a much worse consequence for people. So while I think that a lot of people are concerned about a rapid increase in interest rates and how that's going to affect people, whether a lot of businesses will go out of business because they have too much debt and that leads to layoffs, and people's mortgage rates go up if they're on variable rates, all of these things are terrible things that are the consequence of raising interest rates. But what it seems quite obvious that if inflation does continue to rise and we don't start raising interest rates now, we are eventually going to need to do a dramatic raise. And if we wait and wait and wait, we will end up in the same position we were in the late 70s, early 80s. We will be forced to raise interest rates dramatically, not just, 0.5% or 1%. We'll need to raise them a lot, and then the consequence will be devastating. Of course, inflation may not continue to spiral. It might just, peak around now and then go back down over time. And that's the game that the Fed is playing right now. They are indicating that they're willing to raise interest rates, but they're still being very, very slow about it. They're still hoping that the CPI data just continues or starts to slow down. Not continues, it's been really accelerating. So we'll see what happens, but it's a dangerous game that the Fed is playing, because the longer that they wait, the more likely we're going to see a really, really bad recession once they decide to raise interest rates. So those were my favorite clips from the interview. If you got some value out of this video, make sure you hit that subscribe button so you stay up to date with new content that I post in the future. But with that said, hope you guys have a great week, and I'll see you in the next video.